Good morning and welcome to MarketCast 35 from a very grey, blustery Bournemouth here in the AF Oliver offices, high up in a tower block where the wind really does take effect. I hope you like the shirt this morning, and just the one comment I'm going to make about shirts during this entire 30-minute MarketCast is don't miss the Christmas MarketCast shirt, which I'm going to be doing for the post-budget. Probably the most important market cast that I'm going to be doing this year. And that comes, I'll give you the date at the end, just so you can get it in your diary. Somebody tells me, by the way, that there is a budget coming up. I'd not even realised that. So today, it's going to be a bit of speculation. I've changed the deck quite substantially from that I would normally do, just so that we can get the key data to you. That's the sort of data that I always promise to supply, but really try and get into the meat of what's possibly going to happen in the budget. It looks for all the world, doesn't it, as though property is going to be Rachel's low-hanging fruit. But have a quick look at this summary here, because the budget's set, obviously, 2 weeks and a day, I think November 26th, and the rumours of the property tax changes have been rife. They've been flying the flags and seeing who's saluting, flying the kites, all of that sort of stuff. The rumour mill has been working overtime, but then suddenly, and of course, property looked to be right in the crosshairs because no income tax increase, no VAT increase, no employees' national insurance increase. Where else is Rachel from accounts going to go to find all that cash she so desperately needs? And then suddenly yesterday, I don't know whether you saw all the news reports yesterday, but she has suddenly said, yeah, do you know what? Sometimes we've got to make tough decisions, and if we need to break our manifesto promises, well, then so be it. Oh, very well done. So maybe that takes a little bit of pressure off of the property taxes being so invitingly out there. But look, we'll come to that at the back end of this market cast. What I'm going to do is I'm going to foreshorten the front end. We are going to touch on some really important data as we run through that, by the way, because there have been some surprising data that have fed through over the last week or so. I need to share with you this morning, which actually endorses what I said during the last market cast, that our issue right now is much more one about volumes and not values. Prices generally, and I know it's an on average thing, and I know you hate that because we're all dealing with regional micro markets, but on average, values have actually held up really well. It's the volumes that are the problem. Budget paralysis, which of course we predicted here a couple of months ago. Mortgage approvals did climb. They climbed in September and they almost touched the magical 66,000 level. And of course we know mortgage approvals at 66,000 means completions at 100,000 means the 1.2 million nirvana, the famous or faithful five that ran from 2014 to 2019. It looks like we're heading back in that direction. And then suddenly both the nationwide and the Halifax indexes blipped up last month. Extraordinary. Come to that later, but took us all by surprise. The other thing is consumer confidence as well. For the October numbers for consumer confidence, which came out last week, also blipped up. That was a surprise. Inflation held steady at 3.8%, but regular market cast listeners will know that the really important number for us is the OOH number, the owner-occupier housing cost number, and that again took another very small blip down. But look, I won't get ahead of myself. We'll take a look at some of the detail. I think what I want to do, though, is I want to kick off with this message. This is the overriding message that's coming for this morning's 30-minute trot through where we are in the resi market. And that is this, that there is nothing that we can do. There is no influence that we can bring to bear at this stage that will have an effect on what measures Rachel Reeves takes in the budget that affect the residential property market. So what we need to do, we can't direct the wind, but we can adjust our sails. So we need to change our strategy quickly. We need to be nimble and we need to be agile and we need to be local and we need to change our strategy quickly to account for that. So I'm going to explore some of those possibilities before the end of this market cast. That is the overriding. It's interesting, actually. I originally put the quote, I attributed the quote to Cora L.V. Hatch. Crazy name, crazy girl. She actually quoted that in 1859. And since then, it's been nicked by everybody. I think even Margaret Thatcher used it once, but famously, of course, Dolly Parton in one of her songs. So for all the Dolly fans out there, right, okay. Let's get to some of the serious detail. The inflation numbers came out last week, and as you know, they stuck at 3.8%. We'll look at those in a bit more detail in a minute or two. Next inflation numbers, November 19. I get the sense that we will see a slight reduction of the 3.8% from where we are. And that's crucially important because obviously we've got the MPC coming up shortly afterwards. This is where we sit on inflation. Inflation numbers for September, they actually stayed steady at 3.8%. But look at this number here. So this is the owner-occupier housing costs. And they continue to fall from this high up here, and they dropped again. Okay, only fractionally, but they dropped from 5.3% to 5.2%, which means if you are an owner occupier, your housing costs are more expensive by 5.2% than they were at this time last year. Now, bear in mind that wage inflation is running at almost exactly that on average. It means that that's flat in terms of cost increase, and that has a huge effect on our prospects, the typical people that will actually make up your target audience. So that's a really important number for us, for me, certainly for the market. I think this number is probably more important than the headline number, which all it does, quite honestly, is feed headlines to the newspaper editors. So that's where we stand on inflation. You know that. And in terms then of the next day up, it's when the MPC meets. Well, you know, they met last week. They met on Thursday of last week, and they held interest rates steady at 4%. I haven't bothered to put the chart in there because I've shrunk the presentation down this morning. But what is important, of course, is that they meet again on the 18th of December. They could give us a Christmas present. And I would be absolute, unless there are some horrifying figures come out in the inflation numbers on November 19, I would be absolutely staggered if there wasn't a 25-point cut on December 18, a week before Christmas. That again will have, you can imagine that although that probably won't influence any mortgage rates short term, what it will do is it will have an effect on the January market because the newspapers will love it. It will all be picked up, and there's a real opportunity, I think, depending on what happens in the budget. I think there's a real opportunity for some fairly aggressive, really targeted micro-marketing messages between Christmas and the New Year. So even if that might not be a time for reservations, it's certainly going to be a time for engagement and securing interest, that's for sure, especially if it follows an interest rate cut. I believe there's every chance it will do. Lots to happen, obviously, in between time. The worrying part about this, these charts, I keep an eye on these charts all the time. And even in this shortened deck, I've included them in today. Just to remind you then, these two charts over here, either side, this chart on this side here are average mortgage rates for a 2-year fixed term. And then they're different loans to value. So the loan to value here, right at the top, that green line there, is 95% loan to value, and that's now over 5% on average. And then right at the bottom there, the lowest one that you can see there is down at 60% loan to value, and there are some very competitive down to close to 4.5% rates there. But more importantly, so that's a 2-year fixed term. Over here, it's a fixed loan to value, 75% loan to value over on that right-hand chart. And the reason I draw your attention to it is these different lines on here are the different fixed terms. So 75% loan to value. This orange line at the top here is the 10-year money. And you can see that has actually taken a fairly, not huge, but very noticeable blip up over the last 2 months, which says that the institutions, which says that the markets, that the money makers, they're seeing long-term money getting slightly more expensive. So that is a concern. We need to keep a weather eye on that number there. But right now, the key for us right now, average rate for a 90% loan-to-value mortgage, Fixed for 2 years is just over 4.5%. I think that's quite competitive. And I think if we see the interest rate cut on December 18, which I am virtually certain we will see. I don't know what Rachel's going to do on the 26th, but I still believe we'll see an interest rate cut. Then we might see that even more competitive. The institutions are falling over themselves at the moment to lend everybody money. So where does that leave consumer confidence? So despite the need for us to spend some time on budget later this morning, I do want to take a quick look at this because this really surprised me. We have seen levels of consumer confidence falling and falling over the last few months. And then suddenly last month, it took an uptick. Quick reminder of where we are. This is the zero line through here. So 2,000 people answering this survey. Are things going to get better over the next 12 months? A positive number will come above the line. Are things going to get worse over the next 12 months? It will come below the line. The red line in the middle is the average index score. And this has been at pretty much, it's come from record lows back here. If you come all the way back here to 2023, and those of you that were working and operating at the last quarter of 2023, we know how dreadful that was. And you can see where that came from. And then we built up quite nicely a recovery then into 2024, and the market reflected that. So still not back to the heady pre-COVID steady days where your average sale per live site up at 0.75, 0.8. You can see, but we did get a bit of a recovery, 0.6, 0.65. And then, of course, it took another dip again as we came into that autumn, September 24, and it has been barreling along the bottom there, but it has recently taken a bit of an uptick. You'd have thought with the announcement of the mortgage, the announcement of another great big taxation black hole, all of those issues, that it would have fallen further. And yet, these are the numbers that were published. These were collected in the first 2 weeks of October, that data, and you can see that took an uptick there, the overall score. People still believe, this blue line on the bottom here, that the economy is absolutely in the toilet. These are close to record lows. They're so close to record lows as to be indiscernible. And so everybody feels very downbeat about how the economy is going to do. But have a look at this. Is this a good time for a major purchase? That's the green line there. And that also, while it's still heavily in negative, actually took a significant uptick. And in the meantime, and this is the dichotomy from these numbers, that you've got this, the overall economy, the UK overall economy, the vast majority of the people on the survey believe it's going to get worse over the next 12 months, not better. But then have a look about how they feel their personal finances are going to do. And it's about 50-50. You've got about half saying, I think it's going to be better, and a half think it's going to be worse. Yet at the same time, they all believe the economy is going to suffer and going to struggle. That's a really important set of data for us. And this suggests to me a watching and a waiting audience. And here's the thing, that if we've had a budget paralysis, and if we've had a bunch of prospective buyers saying, I'm going to wait because I don't know what's going to happen in the budget, that means, as inevitably it must, that you've got just the same way as when people wait for stamp duty changes or rush ahead of stamp duty changes. If you get a squeeze at one point, then you get a splurge when that squeeze is released. And so I really think the conditions are right, particularly if we get an interest rate reduction in December. The conditions are right for a good first quarter. I don't believe that there's going to be any major move on prices, but I certainly believe on volumes that there could be a really good uplift, a really good uptick on volumes in the first quarter of next year. We'll come to that later, but that's how confidence is sitting. This took me by surprise. I think took most people by surprise. The nationwide index actually went up from September into October, from the annual number, 2.2% inflation, up to 2.4% inflation. If you wanted to be picky about it, you could call that pretty much flat, but it is still an increase in average prices. It again reinforces that point that I made, that it's not so much the prices that are coming under pressure, it's volumes. I took the liberty of ringing the... I love the Nationwide. Every month when they publish their data, publish their figures in terms of inflation, they always put in something interesting. They always put a little bit of meat there on the side of the plate for us to pick at. And this time they did a renovation survey. So these were the most popular renovations amongst homeowners who've renovated in the last 5 years. And I felt it was worthwhile as I trot past this slide in the deck, pointing this out. Look, bathroom renovations, kitchen renovations, bathrooms, kitchens, they are right in our wheelhouse. That's what everybody wants to improve. Heavens, leave that off to one side and buy new. There we go. Just thought I'd draw your attention to that. Halifax, these numbers came out on Monday, yesterday. And you can see, again, this is a real surprise, but they headline this. And of course, importantly, now whether this has any effect on the price that we're actually seeing in the sales office, that's less important. The important thing is that the newspapers will pick this up. You expect to see the headlines probably or possibly even in today's papers. UK house prices rise at the fastest pace since January. Now, if the Halifax are saying that as their headline on their press release, and they are, you can be certain that you will be reading those headlines in the papers over the next couple of days. Beautifully, of course, you heard it here first on MarketCast. You're ahead of the game, I'm delighted to say. Right move. Their prices, their asking prices, don't forget these are asking prices, not sold prices, so very different from Nationwide and Halifax. Excuse me one moment. Very different from Nationwide and Halifax. Upticked. The prices that were added to the website during October went up by 0.3%. But let me tell you, that sounds good. Normally, at this time of the year, you would expect that increase to be more than twice that. So their little executive summary, which I haven't put in this deck, we haven't got time, but essentially the most important thing in there said that because of the budget paralysis, not their words, my words, budget paralysis, but because of the budget, we didn't see the anticipated autumn bounce. But that was the right move numbers. I stuck this slide in the deck. The Nationwide only published their regional index, of course, once a quarter, which means that these numbers now date back to the end of September, already out of date. But the only reason I always put it there is just to keep us focused on how localized these markets are. So if you take Northern Ireland up there running at almost 10% annual inflation, and you compare that to the outer southeast, you know, the super Mets at pretty much zero, you've got almost 10% difference in markets in the UK. That is huge when you're talking about predictions of average increases across the UK being at 1s and 2%. Well, that is an enormous difference in regional markets. It's all going to be about micro marketing, taking advantage of the market where it gives us the opportunity to do so, and digging in and maybe taking a bit of margin damage where we need to, where the markets are much more difficult. The Zoopla index, 1.3%, pretty much exactly where I was at this time of the year, quite honestly, and no surprise. My favourite of the algorithms, the Zoopla one, by the way, because that's asking prices in there, that's mortgage approvals and completions in there at 1.3%, budget uncertainty, that says in there, causing all the issues, as we sort of know. But when you look at this, this is a good monthly measure, and I always include this slide in the deck. Richard Donnell of Zoopla, one of my, in my view, one of the most knowledgeable and wisest people currently on the scene as a pundit on the property market. This number's very, very good. So this is buyer demand for the month compared to the same month last year, down 8%. First time we've seen that in negative for ages. Flow of new home supply flat. I think everybody's waiting, holding their breath. Stock of new homes for sale, then it obviously goes without saying, if buyer demand's down a bit, supply is flat, stock is going to be a bit higher. But crucially, number of sales agreed, which for last month, which is normally the first month of that autumn bounce, that's a worrying number. It's the first time that's been in negative for quite a while. So it's difficult. It's difficult. Its volumes are suppressed. Buyer demand is down. And if you look at the mortgage approvals here on this slide, they are back up to 66,000, which suggests that we're going to move back to the 100,000 transactions per month, 1.2 million per year, sort of levels that we would expect. But it's a little bit little and it's a little bit late. RICS, just 2 slides in the deck from the RICS. This is their September survey. The headline there, subdued momentum. Sorry, whenever I talk about the RICS, I feel I should talk about that. So you can see it's still evident. They're saying that the sales market is difficult, it's flat, but surprisingly, the values have held up. The canary slides, the slides that give us advance warning of what's going to come. New buyer inquiries over the past month. You don't need me to show you what that is. If you've got North and Northwest, you've got Northern Ireland and Scotland in positive. The rest of the UK are in negative. So they're saying that the inquiries are down on the previous 3-month total. And if you look at new instructions to put properties on the market, well, the picture tells its own story, doesn't it? So budget paralysis right there for you. Looking at what I've stuck these on the bottom there. That's not for you. That's for me, because it's really tough when you're stood next to this screen to see which one relates to how many properties are going to be sold, and this one that says how much they're going to be sold for. But this is a very important chart. We shouldn't underestimate it. It's the surveyors. These are the people that come out and do the valuations. Look, so in terms of the number of properties being sold, both of these measures now, so over the next 3 months, the mauve one, and the 12-month number, the dotted azure blue line, both now in negative. So the majority of surveyors believe that there will be fewer properties sold over the next 12 months than the last 12 months. Very interesting to see that move into negative. And if we look over here, these are values of prices. Are the prices going to move up or down? Over 3 months, you can see that the surveyors are in a very negative mood indeed. Well, there's a shock and a surprise. You never thought you'd hear me say that on MarketCast. And then over the 12-month, we stay in positive, but only just. That actually, I think, is a pretty accurate reflection of where we're headed. All right. Where does that stand then in terms of our matrix and where the market's going to move? And this for me, I think, is such an important transition. So this is where we were a year ago. And you can see that time, because all the stamp duty changes were all just about to happen, weren't they, a year ago? So that was in a big negative. Consumer confidence, very, very low. Mortgage rates, affordability. Fast forward to where we are now, and it takes us to here. But crucially, the one bit I want to draw your attention to here is the addition of this red box in the dreadful bottom right-hand corner square. And by that, I mean high impact, negative effect. And that's uncertainty. If there's one thing a market hates, and it doesn't matter whether it's a market for money or coffee or houses, uncertainty. People hate it. And that sits there hard and fast. But equally, up in this top right-hand corner, weapons that you've got. The second-hand market doesn't have like part exchange and financial packages and price cost control. You can see stood up in the top right-hand corner. Okay, so where do we go next then? This is where we currently are. This is pretty much reflecting where we thought we'd be, although these are actuals. So these are the rates in these blocks, the rate of annual inflation from last year to this year, according to the Nationwide. And as I told you just now, 2.4%. It went up. I'd forecast that was going to be down here. I'm sticking with exactly the same forecast that I started out with last December. Ask Savills what they've done with theirs, by the way, just saying. And then at the top here, this is the UK average price according to the Nationwide. And I'm sticking with what I thought that was going to be too. That's actual to there. So sitting at about 272,000, and I'm staying with the forecast for last year. Quite honestly, that's a done deal. It's almost unimportant. What's much more important is what happens next year. And I think values are going to stay flat. And I think they're going to stay flat across the year. I think we are going to see a spring uplift. I don't think there's any doubt about that. Fairly low increases. And I think that there will be a difficult summer ahead of us, but again, fairly flat. And we'll end up the year either on or just below where we were at the previous year in terms of prices. It's much more about volumes. But obviously, that first quarter is done without the knowledge of what's going to be in the budget. And if Rachel Reeves used that uses that as a really big property tax budget, well, then all bets are off, and we'll come back to that. The really important market cast is the next one post-budget. I think then we can give a really accurate idea of what's coming next. This is the slide I showed you last month. Is she going to use the property market as low-hanging fruit? Well, the rumour mill has been working overtime, hasn't it? And whether you call it flying flags or whether you call it flying kites, however you want to describe that, they have been deliberately, the publicity department in the Treasury have been deliberately feeding rumours out to the press to see how people react, and all sorts of possibilities. Now, what I've done for this morning in the last 5 minutes, I actually asked AI. I said, right, go and check out what's been going on out there in the world, what all the economists have been saying, what all of the newspapers have been saying, all the media outlets, and quantify for me the chances, the probability of these taxes being the one that Rachel Reeves introduces. And look at this. 70% it came in. This is AI coming back saying we reckon a 70% probability that stamp duty will change in some way, either rolling back the stamp duty thresholds or increasing those thresholds, considering an annual property level as an alternative to stamp duty at the time that the property is bought and sold, shifting stamp duty liability from the buyer to the seller. That's another one that's been mooted. So stamp duty reform at 70%, 60%, virtually everyone, so virtually 60%, it's a 60% probability that council tax in some way or other will be reformed. Change of levels, change of way it's applied, a change of how it's the locality in which it's done. Varying levels of council tax for landlords, which we know that already exists, may well also come under scrutiny. 60%. Capital gains tax changes. They reckon there's a 50%, 50-50 chance of capital gains tax changes, aligning CGT rates with income tax, very possibly narrowing private relief criteria as well. So both of those things. Also, the mansion tax is still there. Taxes, there's all sorts of rumours, aren't there? Properties above £2 million, the levy, capital gains tax exemption for 1.5 million value, plus all sorts of things, which of course has really affected the high-end market. And quite honestly, it's the higher value properties in this run-up budget paralysis that have been most affected. And in terms of buyer types, it's the investors, the buy-to-letters, the downsizers. These are the people that have actually been most affected by the rumours that are going on. Those least affected are the first-time buyers. So if these things happen, I'm going to spend 90 seconds on this, but the reason I put these charts in here is what I'm saying right now is we should be all about preparing ourselves. We should be on the start line, ready to run the morning after the budget. If the stamp duty reform, which is almost certainly going to happen, 70% probability, what are we going to do about it? Here's the possible effects. Is upfront costs may well change. And we know it's the second most hated tax in Britain after inheritance tax. So there's all sorts of potential effects of that. But what can you do? So maybe introduce stamp duty deals. We know how popular they are. But most importantly, education of frontliners. So we're talking about this is the big sell for new against second hand, the long-term value of what I call the gentrification bonus. So you're buying your property at the value in that area that it currently has, but just by the dint of this new development being there and gentrifying that area, there is what I would call a gentrification bonus. And people need to know about that because that obviously long-term values, stop thinking short-term. That's really the key message on the stamp duty message. Council tax reform. So this is almost certainly going to result in higher annual costs, particularly in homes in areas where there are undervalued bands. Think about possible responses for that. Transparent cost comparisons, new against second hand. So much of these tax changes play right into the wheelhouse of the new homes industry. This is, for me, a moment where we could steal significant additional market share. So all sorts of potential here. I'm not going to spend time on each of these slides, but perhaps take a run through this on YouTube, freeze these frames and take a look at some of these just general ideas. Of course, these are very much general ideas because the specific ideas are going to vary according to each individual developer and each individual region and each individual site. It's all going to be about micro marketing. Capital gains tax changes, well, then this is going to have a big effect on downsizers, big effect on investors. But again, we can maintain our focus on the audiences that are unaffected by this, and then go to work on crafting ideas for the audience that is affected. But there will be if this is the case, it's probably only 30% of your prospective audience that's actually going to be affected by that. So we need to keep that in mind. And finally, just as a last one to throw in there, the mansion tax. Well, that could have an effect on high-end purchasers. These are purchasers, who knows where they'll set that limit, but 1.5 million, 2 million plus purchasers. Again, it's all about adjusting stuff up front to compensate. It's focusing on the audiences that are unaffected and then working hard as well with your partners like your independent financial advisors to possibly offering, obviously not you, but those who can legally do so, a bit of tax planning advice for people if changes like this come. All of that must come under consideration. I have deliberately just floated in some thoughts and ideas. It's going to come down to each individual development and each individual site. And that's something, obviously, from our point of view at AF Oliver, that's something we'll do individually with our clients. So in summary then, I think the budget could provide a big opportunity for new build to gain significant market share over secondhand. I really think there's an opportunity to do that. I'm staying with my volume forecast of 1.2 million. It's under threat a little bit because of this budget paralysis that we've had. I won't be too far out, I'm pretty sure. New home share, I think we're going to finish at probably about 11.5%. We'll see how this last quarter goes. And 2026, I think, looks to be flat in terms of prices. But I do think there's going to be a big opportunity in terms of volumes in the first quarter of next year. This is all now really about you meet the morning after the budget, and then you set out your plans for the first quarter of next year. And believe you me, we will be meeting with consumers immediately after the budget so we can advise our clients on exactly the reaction and what that's going to mean in real terms. So to finish off then, you can't control the wind, but you can adjust the sails. So have a meeting there around the chart table the day after the budget. We'll be doing that. This crucially, date for the diary. There we go. It's the budget special. So today has been all about speculation. This might happen, that might happen. You could think this, you could think that. Really, it's not so much those exact steps. It's the principle of having plans ready to go so you hit the ground running. But what we will be doing on the 9th, Tuesday, the 9th of December, is we'll be doing a budget special where I can be much more specific about what those changes mean. And I'll also try and give you a bit of insight about how the public have reacted to that and what they might do. Okay, hope you've enjoyed the last 34 minutes. Sorry, I will see you. I'm going to dash. I will see you on Tuesday, the 9th of December. And in the meantime, fingers crossed for the 26th.